Toby Hales is flying with Qantas for the first time during the pandemic.
There was some period of anxiety, I guess, about getting back on a plane, and especially with Omicron, but I feel like confidence has been restored.
That is good news for the national carrier after more than a bit of turbulence.
It has been honestly a real roller coaster ride.
Qantas lost almost $500 million in the last 6 months of 2021. That is far better than the $1 billion it hemorrhaged in the same period a year earlier. But analysts say this improvement was helped by the sell-off of land near Sydney Airport.
This is just a part of the recovering plan, and the others include, for example, the restructuring of its fleet, retiring the 747 replaced with the A321. Overall, the result is very, very encouraging.
Qantas's recovery hinges on the return of domestic travel, and it's assuming that we'll all be back flying within Australia at normal levels by as soon as June. When it comes to international travel, however, the future is less rosy. It's not expecting to sell more than half the overseas flights that it did before the pandemic. Qantas is offering 20,000 staff company shares in a bid to keep them on board. That's as it faces ongoing disputes with the union over the outsourcing of jobs.
What good is a share to a worker when the very next day a callous Qantas management could stand up and contract out your work?
Stocks for staff, but no shareholder dividend.
Qantas shares were sold down further after the Russia-Ukraine news broke, ending more than 5% lower. The airline's CEO, Alan Joyce, joined me earlier. Alan Joyce, welcome to The Business.
It's good to talk to you again, Alicia.
You've described the last half as a rollercoaster of expectations. How confident are you can meet your fourth quarter forecast for 90 to 100% capacity domestically?
Our belief is we are in a position where we'll get to 90 to 100% of pre-COVID domestic levels by the last quarter of this financial year, and we'll get in the first quarter of the next financial year up to 70+% of our international operation because of those high levels of vaccination. And because the borders are open and everybody's saying they will stay open.
You've been selling assets like the land in Mascot to free cash flow. In the event of an unforeseen economic shutdown, do you have any assets left to hive off to ensure your debt repayments can be met?
Yeah, so we are at the lower, we're in the range of our debt range that gives us the position of one of the few investment-grade airlines in the world. So we're very comfortable in our liquidity position, in our debt position. We're one of the best positioned airlines in the world. We've still a long way to go to recover from what COVID's done to us. We still have to make sure that we deliver on the recovery programme, to deliver on the $1 billion worth of savings, but we're well strategically placed to take advantage as we come through living with COVID and get to the other side of the COVID crisis.
Today you announced you're going to offer 1,000 shares to employees to reward them. Why not just pay them cash? What's the thinking there?
So there's a couple of things that this is linked to. One, it is linked to the company getting back into profits in financial year 23. When you do rewards like this, you are in a position where you have to pay for it, and you have to be in a position when you can afford to pay for it, and we need to start making money again before we can do that. Secondly, we want it as a retention bonus. Particularly in some of the head office roles, we have a high turnover, and we want people to be exposed to the upside of the Qantas share price.
And on the staff retention issue, you flagged it as a problem. Why do you think they're leaving, and where are they going? Are they staying within the industry or going to other sectors?
Now, within the industry, we're attracting people from other airlines, whether it's pilot, engineers or cabin crew. The issue for us is not in those frontline areas. It's more the technology jobs in head office. It's executives. Qantas management team is seen as one of the best in the country, one of the best in the world when it comes to airlines. And we have people in the country, the banks, the telecommunications, the professional services going after our people because they know that Qantas has gone through a tough period.
Well, inflation was described as live and real by the Woolies boss yesterday. You've said your fuel prices are hedged for now. Where are you seeing inflation, and will it translate into higher ticket prices?
Well, we have the dynamic that fuel is probably the biggest area of potential inflation for us, with fuel price being at $100. That is one of the highest it's been for a long time. But our hedging is very effective until at least June. It fades down a little bit post that. So hopefully we'll have resolution of what's happening in Ukraine before then, and we can have normality brought to oil prices. If that doesn't happen, we can then adjust our business to cope with that. We would be adding or reducing capacity where the economics don't work.
But ultimately, do you think ticket prices will have to go up?
But if you're forecasting $100 oil prices forever, that has to be recovered, and that will come true in airfares.
There are a lot of travel credits washing around, and the ABC has reported a bit of confusion about how they work. Does there need to be more consumer education on how the travel credits work versus cash, for example?
No, so we've been very clear on it. We've given huge flexibility on people's travel credits. So if Qantas cancels a flight, the travel credit that you could get a complete refund if that happens because of border closures, because we've taken capacity out, and you can use them for any airfare domestically, internationally. But if you make a decision to cancel the flight, and the flight's still there and the border is still opened up, we restrict you just to buying the exact same airfare in the future. That's a lot more flexibility than people have had before COVID, and only 5% of credits are in that category.
At the end of 2023, when the recovery plan is complete, do you expect shareholders will see a dividend again?
We can't give an outlook and a forecast, and we don't do that. You know, our intention and our process is very clear. We have a financial framework. If our debt gets back into the bottom of that level, which is our target, which makes us investment grade, and if after we spent the money on renewing the fleet, we have free cash flows, we will distribute that to shareholders.
Alan Joyce, thank you so much for speaking with us.
Thank you. It's always good. It's always a pleasure.